Okay, so we'll go ahead and get started. I'm going to share my screen. So we wanted to start, just with a quick review of the first half of the year. This is the asset allocation of the first half of the year, where the blue colors are fixed income and cash. So you can see we went into the year significantly underweight equities at about 50%. Global equities, on the back of 2022 when risk premia compressed, and momentum was negative across every, global equity market. The main thing that changed in 2023 is that momentum flipped again in every major global equity market, really with the exception of US and international real estate. Basically, for everything else, momentum flipped positive. And as that happened, first in Europe, then the US, then the rest of the world, our asset allocation went from, significantly underweight to pretty neutral, and now just a little bit overweight, as risk premia remain really healthy outside the US. Momentum's positive. And then in the US, a more neutral position where risk premia are pretty tight, but momentum is also very positive. Putting this asset allocation in the context of a slightly longer period, this is what it's looked like since the post-COVID period, really COVID and post-COVID. So this starts in December 19. This period here was, it was COVID. Then we were really max long equities from May 20 through October 21 or so. This period, from October 21 through December of 22, October of 22 maybe, as we were de-risking, was really driven both by momentum flipping negative, and by risk premia compressing everywhere, as TIPS real yields moved from -1.5 to +1.5. This is what returns have looked like over the first half of the year so far. It's been a period of material underperformance for us, about relative to the static baseline, about 275 basis points of absolute underperformance, about 75 basis points of vol adjusted underperformance. So as you can see, we had lower returns, but also with materially lower vol. A number of people have asked us over this period, if the underperformance worries us. It doesn't worry us. We're never happy, to see underperformance, but we do expect it. And, it would really only worry us if the character of it is something that we wouldn't expect, either in quality or in magnitude. The theory behind Elm and our expectations for Elm are not that we'll outperform in most environments or most periods, but that, and certainly not in every environment or every period, but rather that there'll be a fair amount of outperformance, a fair amount of underperformance, but over time, the outperformance will dominate the underperformance. And indeed, that's what we've seen happen. Zooming out to again, the COVID and post-COVID period, over this time, there have been a couple periods of underperformance, several periods of outperformance, but the outperformance has dominated the underperformance. Over this period, about 72 basis points of annualized outperformance. Another question kind of related to what's happened over the course of this year that we've gotten a fair amount is, what the strategy is doing to respond to the Fed cycle, to, very significant changes in short-term interest rates, and to the inflation dynamics, the really dramatic inflation dynamics we've seen. And, the answer is that we, by which I mean Elm, doesn't respond directly to short-term interest rates, long-term nominal interest rates, or inflation dynamics. Rather, all of those things get wrapped up in long-term real yields, and which we use the 10-year TIPS real yield as a proxy for the long-term real risk-free rate in general. And it's that long-term risk-free rate that we respond to through its involvement in the equity risk premium. So the equity risk premium is the expected real return of equities in excess of the long-term risk-free rate. Almost all of the assets we hold, the equity assets we hold, are long-term assets. And so we think it's appropriate, I should say long-term real assets. And, we think it's appropriate to compare them in thinking about risk premium to a long-term real risk-free rate. So it's the 10-year TIPS real yield that is the interest rate that we really look at. And, this shows its history over the last 5 years. And as you can see, while there was an extremely dramatic move from the beginning to the end of 2022, over the course of 2023 so far, it's really been very quiet. It's just been bouncing right around 1.5%. So, in terms of the interest rate dynamics that we focus on, it's been very quiet so far this year, though it was very dynamic last year.
So, I think that I'm going to talk a little bit about international diversification, but before I do that, just following up on what James was saying, that in thinking about performance and thinking about these past 2 years, I'm really quite happy with how the Elm portfolios have navigated this move from in interest rates from -1% on TIPS, or basically close to zero on nominal rates, to over 250 basis points higher now, with TIPS trading at 1.6%. I mean, that going back 2 years to July of 2021, the performance of our clients' portfolios over that period is about unchanged in nominal terms. So, there was, it went down and then back up again. So roughly a zero return over the last 24 months. But here we are today in an environment where interest rates, we have a real interest rate of 1.6% instead of -1% back then. And actually, the earnings yield on the global stock market portfolio, the US plus non-US, is substantially higher. So somehow we got from 2 years ago to today without losing value in portfolios, but sitting now in an environment that has much higher prospective expected return. So if we thought about just taking the expected return of our baseline portfolio, so 2 years ago, you had a -1% on TIPS, plus take 75% of equity risk premium at that time, which was about 75% to 5%. So that was an expected return on a portfolio without thinking about changing asset allocation of like 2.8%, under 3%. And today, when we do that calculation, we're over 4%. So we've gone from under 3 to over 4, from 2.8 to 4.3, which normally, you get higher expected returns on your portfolio after you lose money, when the value has gone down and hopefully cash flows expected in the future haven't gone down as much. So I think that's really, something that, I feel good about, and it's just nice sitting here today in a much more normalized investment environment with, with interest rates giving us some positive real rate and global risk premia anyway being reasonable, even though the US is very tight. Anyway, so I wanted to just finish what James was saying in terms of the portfolio, where we are and all of that, to bring it to today. What I wanted to talk a little bit about in our prepared remarks is international diversification. I mean, most US investors, or the typical US investor, has about 85% in US equities and 15% in non-US equities, whereas that at Elm, we believe in a much more diversified global approach to investing. So our baseline portfolios are more like 60% in US equities and 40% in non-US equities, which is actually, we even think that's not enough as in the baseline, but that's what we use, which is pretty close to current market cap weights as per MSCI and FTSE. But that 40% in non-US equities is larger than most US investors have in their portfolios, and we've been running even more overweight than that because non-US equities have had a higher long-term expected return. They've been trading at a much lower price to earnings ratio or a much higher earnings yield. Really, pretty much over the past 10 years, it's been like that. But the US has massively outperformed non-US equity markets. Going back over the past 30 years, US equities have outperformed non-US equities by 3.5% per year over the last 30 years. And the last 10 years was over a 6% outperformance, US versus non-US equities. So, a lot of people really question the whole idea of investing in non-US equities. One investor wrote to us and said, would it not make sense for Elm to be overweight US equities because it seems that our entrepreneurial spirit, educational institutions, laws, lax regulation, robust labor markets, demographics, access to capital, et cetera, will continue feeding our tech companies and allow us to outperform the rest of the world in our equity markets. We wanted to address that and talk about that in our quarterly letter that we sent out. We pointed you all to take a look at this excellent, what we thought was an excellent research note by the researchers at AQR, the quantitative asset manager that Cliff Asness was one of the founders of. And they wrote a piece called International Diversification, Still Crazy After All These Years, where they really covered a lot of the different aspects of this question of, does international diversification make sense? I think they missed one thing that I'm going to bring up at the end, but their points were really well articulated, and we were actually surprised by one of their points that they made, which we went back and looked at our own data to verify. So I think in some ways the main point that we liked the most from their paper addresses this question from our investor that I just read to you, which is like, well, gosh, isn't the US just a place where companies can grow earnings much faster than in the rest of the world because the US is this much better business environment in all these different ways? And what's really remarkable is that the last 30 years of US outperformance was driven almost entirely by a change in valuation ratios rather than faster US earnings growth. So going back to 30 years ago, the price earnings multiple in the US was 20, and in non-US was higher at 25. So non-US companies were trading at a higher multiple or a lower earnings yield 30 years ago. And today, as you know, the price to earnings ratio in the US is 2 times higher than the weighted price to earnings ratio in the rest of the world. So we kind of went from the earnings yield in the US being 75, let's see, what's the right way to say it? That the earnings yield in the rest of the world went from 75% of the US earnings yield 30 years ago to twice as high today. And just taking that by itself explains just under 3% of the 3.5% outperformance of US equities versus the rest of the world. And another part of that outperformance can also be explained by the real appreciation of the dollar. So that this story of faster US earnings growth just isn't the story of the last 30 years. Now, maybe it's going to come, over the next 30 years, we don't know. But to the extent that it hasn't happened over the past 30 years with all the different technological advances, et cetera, I think is a really important thing to bear in mind in terms of this thesis that somehow the US is able to grow earnings much faster, all else equal versus the rest of the world. The other thing that I wanted to add to this, is that AQR didn't discuss, but I think is a really interesting point is probably many of you have heard that Warren Buffett and others, suggest to people just invest in the S&P 500. That's all you need to do because after all, so many US companies derive so much of their earnings from international markets that you don't need international diversification. Just invest in the S&P 500 and you're going to get all of these foreign earnings, profits that are derived from foreign markets without having to invest in foreign companies. Well, it is true that 30% or just over 30% of US earnings and revenues of the S&P 500 come from international operations. But I think what people don't talk about, which is a really interesting point, is that if you're buying those earnings via the S&P 500, you're buying those earnings at a price to earnings multiple of the S&P 500. Whereas if you buy them directly by owning non-US equities, you're getting them at half price. You're getting them at the price to earnings multiple of non-US equities. So it's kind of like when you think about it like that, and you think about US equities, you say, well, if I'm going to price their international revenues using the price to earnings ratio of non-US equities, then the US earnings that I'm buying are even at a much higher multiple than they seem to be with it all blended together. So anyway, I just wanted to talk a little bit about this international diversification. And as we sit here today, US equities, when we think about the earnings yield of these broad markets minus the real rate on the safe asset of TIPS, we're seeing something really dramatic right now. The US equities are giving us an extra 2% long-term expected return relative to TIPS, whereas the non-US market is giving us over 5% extra long-term expected return over TIPS. And that's a really dramatic multiple, dramatic relative relationship. And and that's why when you look at our asset allocation, we're somewhat, somewhat underweight U.S. equities right now, and overweight, and fairly dramatically overweight non-U.S. equities, and that's really where it's primarily coming from, since everything is, we're in this lower risk environment with positive momentum right now across the board, but those long-term valuation expected returns are really dramatically different. So, okay, James, back to you for the next segment, and we'll take questions on all of this, obviously, afterwards.
So I'm going to just say a few brief words about something we talked about in our quarterly letter, which is the upcoming changes to the Elm Global Balance strategy. Over the years, our strategy offerings have expanded a bit, where right now we have a global balance strategy in taxable format, non-taxable format, US UK format, an all equity strategy in the same, sector options. It's become kind of a slightly unwieldy collection of strategies. And both in the interests of simplifying all that and in the interests of accommodating clients who have needs beyond just what those two default strategies can offer, we're consolidating everything into one Elm Global Balance strategy, for which clients can customize the baseline through two dials they can set. One, which will basically set the risk level of the strategy through the baseline equity allocation, and the other, which can set the amount of the mix of U.S. versus non-U.S. equities. And I'm not going to go into too much depth on it right now. We'll be sending out a much more detailed note in the coming weeks about the strategy. But I just wanted to reprise, what we mentioned in the call, in the quarterly letter about it. And our doing this is really driven partly by a desire to simplify everything, partly by having a much more sophisticated technology platform now than we did 5 or 6 years ago, and the ability to do it. And, partly by the financial planning and portfolio choice work we've been doing with an increasing number of clients, and wanting to have a baseline and a product that we could offer clients as a result of that portfolio choice work, that would be appropriate for them. One of the questions we got about this is, whether there'd be an option to set the baseline at 100% equities, and there will be such an option. I'm going to share my screen. So, with the new global balance strategy, if you set the risk dial to 100%, basically that means the baseline will have 100% equities. And then whenever the dynamic allocation wants to be overweight, it'll just stay at 100%. Whenever it wants to be underweight, it'll go underweight. So as you can see, over the last 20 plus years, it's mostly stayed at 100%, with a few significant excursions away from it. Our guess,
I think 15 years, James, right? Is that 08?
Sorry, 15 years. Yeah.
Yeah.
Our guess is that most of our clients in the current all equity strategy will be interested in moving to this setting. We're not forcing anyone to, but our guess is that this will be a more appealing strategy for our all equity clients. There's still a number of details that we're still working out, in terms of the flex strategy. I hope we'll answer a lot more questions, when we send out a detailed note in the coming weeks. But feel free to reach out to us, anytime to talk more about it too, for anyone who's interested.
Yeah, I think we're really excited about this for U.S. clients, and this we can do it for everybody. One day we think we will. So I want to talk about another new product that we have in development. So whereas what James talked about is ready right now, we've also been working on a direct indexing tax loss harvesting offering too. We've been working on that for quite some time. We're in live testing right now. We have a portfolio that we're running with it. And the idea here is that a client opens a separately managed account, and we get that account invested in, say, an index like the S&P 500. We're actually using the Bloomberg 500. We think it's a slightly better index, and that you own, every stock in that index in its market cap weight, and we try to manage close to that index, but realizing capital losses where we can, and trying to manage the risk of that. Realize the loss, wait for over 30 days in terms of wash sale rules, rebalance the portfolio, etc. We have different settings for it, in terms of if somebody really just would like to get to generate short-term losses over time, and doesn't mind getting long-term capital gains offsetting that, so sort of generating as much total capital losses as possible, but with an idea of generating short-term losses versus some long-term gains, we can do that, or we can just set it to only looking to generate capital losses. We expect that we'll be able to customize it. So if somebody has an appreciated holding of, say, Apple stock, that we could create a portfolio that wouldn't have Apple or wouldn't have tech stocks in it potentially. It's all it's getting close. We're now very we know we're going to do it. That's why we're talking about it now. We want to let you know about it. We want to start having some conversations. Exactly the different aspects of the structure in terms of fees, in terms of how integrated it might be in our global balance strategies. All of those things are yet to be determined. But we're going to have a simple U.S. index-based product up and running and available for everybody pretty soon. So feel free to be in touch with us about that. We think that we do a good. We think that we've developed a good version of this compared to other things out there, and we're pretty sure that our whatever fee we choose on this is going to be substantially below the fees that we see from people who have been providing this elsewhere. So anyway, stay tuned and be in touch, and we're excited about this development too.
Great. Another development we're really excited about is that some of you probably know we've been working on a book for the last several years called The Missing Billionaires. Feels like it's been for several decades sometimes, but it's really only been for a few years now. And we're very pleased, that just a couple of weeks ago, we signed off on the final proofs for the book, and it will be available in early September. All of our investors will be receiving 2 copies from us, so no need to rush out and buy it. We will also be doing an investor call, like this, just to talk about the book. So it'll be a fun forum to talk about it with everybody. And we also expect to do a book launch event, at least one in New York and one in London. Though those haven't been scheduled yet, we'll keep everyone abreast of the details. Victor, anything else about the book?
Yeah, I mean, maybe I was thinking, since you were sharing your screen, maybe you could share the screen and show people the cover, either from the Amazon page, page, or from the PDF.
Yeah, let me get it up.
We're super excited. Yeah, we're excited to send out copies to everybody, but you can also buy it on Amazon. But our intention is to send out 2 copies, one for you and one to give away if you like it. Yep, there it is. Yep, cover by our friend Jeff Rosenbluth, did the digital art for the cover. What's that? Okay, so I guess we're into Q&A now, James. Is that right?
Yeah, let's do the three write-ins, and then we'll go to the chat.
Okay. Yeah, the first one is the first question is really interesting. I think somebody was asking us, how can you think of TIPS, of inflation protected treasury bonds, as being an inflation hedge when the value of TIPS, the price of TIPS went down as we got this whole inflation surge over the last couple of years. And it's a really interesting question. And this morning I was talking with one of our investors, and he was saying that he was explaining that years ago he had bought savings bonds, government savings bonds that were indexed to inflation, and he was really happy about this. He bought them at a nice, relatively high yield, and he was really happy about it. It was giving him this inflation-adjusted cash flow over time, and he never even thought about the fact that if they had a price, which they don't have, because they're not traded on the market, if they had a price, the price of them would have gone down over the last couple of years as real rates went from -1 to 2% on these bonds to +1 or 2% on the bonds. The value of his portfolio of these savings bonds would have gone down a lot. But since he doesn't see a price anywhere, he didn't think about that. And he thought about them as being a nice hedge of the real income value equivalent of his wealth. And really, I think that the answer to the question of how can you think that TIPS are an inflation hedge when their price goes down when we get a surge in inflation, and the reason the price tends to go down is because we get a surge in inflation, the Fed starts hiking interest rates, real rates go up, and so the value of these bonds goes down, even though their cash flows remain inflation indexed for us. So I think the answer to that question of how can they be an inflation hedge really gets to the heart of this question of what is it that we're trying to protect? Are we trying to protect the inflation adjusted value of our wealth as per our brokerage accounts today? Or what we think makes more sense is that we're trying to protect the consumption, the real spending that our wealth can generate over our lifetimes or potentially over our lifetimes and future generations' lifetimes as well. And so, in that sense, TIPS are a good hedge if we're thinking about hedging out this the real income equivalent of our wealth, but they're not a good hedge if we're trying to have the value of our portfolio today, as per our brokerage accounts, stay constant in inflation-adjusted terms. So I thought it was a really great question and topic, and it doesn't really have a right or wrong answer. It just depends on what it is that you really want to be protecting. And if you are protecting what we think makes a little bit more sense, which is this long-term real income stream, well, then it's nice that TIPS actually gives you that protection. If you're trying to protect the real value of your portfolio today, that's a really tough problem. That we don't have any, there's not a lot of great suggestions for how to do that. Maybe, running a position short nominal bonds or something like that might help a lot of the time, but there's nothing that's really going to do that too perfectly right now.
Another question, we had from several people was, especially in this year of, such dramatic sector performance differentials, in the US at least, why at Elm we don't apply our methodology, down to the sector level. And it's a great question. First, let me say we do have a strategy option, which will persist, in our new global balanced consolidation, where we can take the US equity market, and instead of expressing that through one broad ETF like VTI, we break it up into all of the sector funds and own all of the sector funds. However, we do that not because we think it improves anything about returns, but because it improves tax loss harvesting. So there's more sector dispersion than broad market dispersion. So if you break up the market into all of the sectors, you get more expected tax loss harvesting. And then, once we add a direct indexed option, you'd get still more, if instead you instead of breaking up into the sectors, you break it up into, each of the individual stock constituents. So we already do have a sector option really for tax loss harvesting, where the cost benefit of that is you get more expected harvesting, but at the cost of a more complex account, double the names, more trading, etc. The reason why we don't apply the full Elm dynamics at the sector level is that we don't believe that at the sector level the risk premium is meaningful. as it is at the broad market level. The big idea, one of the big ideas behind why cyclically adjusted earnings yield is a decent forecaster of the long-term real return of equities, is that in the big picture, total market earnings are somewhat bond-like. They're not totally bond-like, they have volatility, but they have significantly less volatility than the overall equity market does. And so if you basically take cyclically adjusted earnings divided by price, and those earnings are somewhat bond-like, that gives you a decent forecaster of expected return. As you get away from broad economic aggregates towards the sectors, and then even further towards individual companies, earnings become less and less bond-like. So obviously at the level of an individual company, earnings can be extremely volatile. And even at the sector level, there's so much volatility in earnings and variation across the sectors that the methodology we use, which we apply at the broad market level, just doesn't work as well. Victor, anything more on that?
No, I think that was good. I think that was good coverage. I mean, that kind of came in the same question of talking about U.S. exceptionalism, actually. So that was a good interaction we had there. So the next question we had was, some people just wanted to ask us about the NASDAQ rebalancing. I don't know how many of you have heard about this, but the NASDAQ index of technology stocks has this built-in rebalancing mechanism where when the top companies become too large, they cut the weights of those companies. So Apple and Microsoft being the two biggest ones there. And then they come up with these new weights. So anybody that's following that index, and in particular, the ETFs that are indexed to the NASDAQ 100 index, have to do trades in the marketplace to get back to the index weights. And there was a really good article by Matt Levine from Bloomberg touched on this and sort of pointed out that the way that NASDAQ talks about it, at least superficially, that it was going to have a pretty perverse result where I guess that Facebook or Meta was going to wind up getting an increase in value, an increase in weight in the index, because it was just under the threshold that they had, I think, of 4.8% of the index, or how they were going to do the reweighting. But NASDAQ sort of made it more sensible, and they are cutting the weights of the top 5 or so of the index constituents. It doesn't really have an impact on what we do at Elm. It doesn't have an impact on any of the ETFs that we use as part of our portfolios at Elm. But it was a kind of interesting case, and of course, it just brings up this question that people ask: are market cap weighted indexes getting too concentrated in the top name? But by the way, there are similar rules built into some other ETFs. So in some of the sector ETFs, for instance, there could be reweightings of the constituents down the road. Right now, NASDAQ is the only one. The NASDAQ 100 is the only one doing it, but some of the other indexes might do it, like the technology index in the SPDR, or the S&P technology index, which is what State Street indexes their sector ETFs to. On the question of, are these stocks sort of too big within the index? We wrote about that maybe 6 months ago. We wrote an article about that. Maybe it was a little bit on the technical side. We were talking about, that given that, say, Apple or Microsoft are about 3.5% to 4% of the global stock market index, just how big is that? How much extra return should they need to earn because they're so big and they're not fully, their risk is not being fully diversified away in the global index because they're because they're relatively large. And what we found and talked about in that paper was that effect is not very big, that being 4% of a global index doesn't seem like that's such a big weight. When you think about these companies, they have a lot of activities going on in the companies, right? I mean, we know that Microsoft has got a big software business. They also have a really big web processing business as well, web computing business, cloud computing business, I should say, as well. So anyway, we're not too concerned about these weights. It's also not really historically, it's not really unprecedented at all. I mean, there have been times when there's been quite a lot of concentration. It's more comfortable if the concentration were smaller. It would be more comfortable for us, for everybody. If markets, if the return of the market was more broadly distributed, but it's just the nature of equity markets that most of the return comes from a very small number of stocks. I mean, that's just how markets have always been. Going way back, we can see that the value creation in stock markets just comes mostly from a relatively small number of stocks. So we don't think that we're in sort of unprecedented times. It's a little bit uncomfortable, but it's not, it's not something that's keeping us up at night. And the Nasdaq rebalance was kind of interesting and also shed some light on just this question of concentration in general.
Great. I see Ravi has his hand raised. Shall we take that?
Hey guys. Great presentation, and look forward to the book. I just had a comment on the global equity risk premium versus the U.S. equity risk premium, and I sort of agree with your comments that you don't probably want to rely on equity risk premium measured at the sector level, but I think a large part of the discrepancy in equity risk premium between the US and the rest of the world comes from the sector composition. And you probably have a value tilt anyway. You'll be, you're probably tilting towards value a little more. So for example, the tech sector is a big part of the US indices. If you disaggregate down to, I think I've made this comment before, by sector, large companies within energy, consumer staples, pharma, big pharma, autos, the global industries, it doesn't look like the ERP is that different between top-notch US companies and top global companies in the rest, which listed in the rest of the world. I think it's all gets down to difference in sector composition, which may be fine to tilt towards value, but to do that twice over might be, in other words, have a tilt towards value within the US and then again do it I agree with your comments about global diversification. There may be all kinds of other good reasons to diversify, including people are tagged to domestic indices and there are flows in and out of equities, risk assets driven by local dynamics. So I agree with the general concept of global diversification. I just think that the valuation tilt towards the global stuff might be overdone because of this sector difference.
So Ravi, going back to, it's a little bit dated now, but in 2019, we took a look at that actually.
So we had done that back in our time at PIPCO, and we didn't find any difference outside of the sector difference.
Mm-hmm. Yeah, so we looked at, so we actually wrote a paper called "Do U.S. Industry Sector Weights Explain the Higher Valuation of U.S. versus non-U.S. Equities?" It was something a client had asked us about, and at least in August of 19, we found that we didn't find the valuation differences as being explainable by different sector concentrations. I'll send you the paper. It's a few years old now.
There's nothing like Apple, Microsoft, Google, Meta in the rest of the world. So you have to take that out when you make this comparison.
Yeah, Apple, for instance, those aren't the companies that are it's not trading at a crazy valuation either.
Yeah, but it's still
we should send the paper. I was going to actually share the screen, to show it. But yeah, anyway, let's talk about that offline, Ravi. Maybe we can.
But I agree that I'm not saying anything negative about global diversification. That makes a lot of sense. So.
Yeah, and maybe we can redo the analysis.
And the other question was, isn't your equity risk premium measure gone down quite a bit with this big swing in real rates from -1 to +1.5?
Yeah, it certainly has.
It has.
Yeah, I'll include a chart of equity risk premium by market in our post write-up.
So it's momentum that's keeping you in equities.
Correct.
Yeah.
Well, momentum and the fact that outside the US, even though equity risk premiums have contracted, they're still quite healthy. They contracted from high level. For instance, they went from an average of 7% to an average of 5% or something.
But Victor was saying that the CAPE earnings yield has actually gone up. Is that right, Victor? The CAPE.
From 2 years ago. From 2 years ago, the earnings yield has actually gone up overall.
And that is the CAPE, not the spot.
Using the last 10 years of earnings. So basically, from 2 years ago, in our numbers, the earnings are a bit higher, and some of the markets are actually lower. The U.S. is higher, but other markets are lower. So the earnings yield of the whole equity market is a bit higher over the last 2 years. The risk premium is a bit lower because of the change in the risk-free rate, and the expected return on the portfolio is a lot higher. So that's what I was saying in those sort of
I got it. Yeah, I was just making.
Yeah.
Thank you.
But yeah, the nice thing is the expected return on our investment portfolios are much higher today than they were 2 years ago.
We had a question in the chat. Shall I take it? So the question says, going back to the Warren Buffett comment earlier, the S&P 500 has outperformed the Elm Global Balance strategy over the past 5 years. What are your thoughts? Do you expect market conditions to change and be more favorable to the Elm strategy? So first let me say, I think market conditions have been favorable to the Elm strategy. Over the last 5 years, we don't regard the S&P 500 as a benchmark for the strategy. It's not trying to beat the S&P 500 or compare to the S&P 500 in any way. For a variety of reasons, the global balance strategy has a baseline of 75% equities, 25% cash and bonds. That's not because we think 75-25 is going to have better returns. It's because we think for most investors with normal risk aversion, being fully invested in equities is not the right risk level. And in that there are non-return reasons to want a lower allocation, than 100% equities. Similarly, I think about global diversification and diversification in general, primarily in risk terms, rather than in return terms. I think Buffett also said that if everything in your portfolio is doing great, you're not diversified. One big decision, we made about Elm is that we want this to be a strategy that is appropriate for very large fractions of people's wealth. It's essentially all of our wealth for me and Victor. We have many other clients for whom it's, very large fraction of wealth, and others for whom it's a smaller fraction. But we want it to be appropriate for large fractions of wealth And, one thing that means is we want it to be really highly diversified. And there are a range of investment choices that can't just be made on the basis of returns. So for instance, over almost any period you look at, Apple is going to have better return metrics than the S&P. Higher returns, higher Sharpe ratio. If you, based on almost any standard investment metric, you could say, why invest in the S&P? Why not just invest in Apple? Over almost every period, Apple's beaten the S&P. Yet at the same time, I think people recognize that owning the S&P is in some sense lower risk than owning Apple, that it has a diversification benefit, that doesn't necessarily show up in any particular sample of data over 5 years or 10 years or whatever. And that argument holds, we think, all the way up. We don't have any particular view about which global equity markets are going to outperform over the next year or a few years. We do look at risk premia, which tell us that U.S. equity risk premia are much lower than non-U.S. equity risk premia, which statistically at least suggests lower expected excess returns for U.S. equities versus non-U.S. equities over a long horizon. Over the medium term, we don't have any particular view. We think it's very hard to have a view about which equity markets will outperform going forward. Historically, it's not been very consistent. Just because one equity market outperforms for a decade or so, then it flips and another equity market outperforms for the next decade. And that difficulty in figuring out which equity market is going to do the best over the next period is one of the arguments for global diversification. They're not the only one.
Yeah, I think that this question. I think the biggest question facing investors these days is this U.S. exceptionalism and trying to understand it, and trying to respond to it. And I think it's very natural to see this outperformance. 3 decades is a long time. 1 decade is a long time, let alone 3 decades. And just to start, explaining it in, that it will always be this way. Well, first of all, if it were correct to have expectations that the U.S. would outperform the rest of the world by 2% a year, we would have to say that markets are being pretty inefficient, right? Like that just would not be an efficient solution. That would not be consistent with efficient markets. So that's one place to start and to think about it. Another thing that we haven't talked about, although we've written about it in the past, is just trying to understand why have we seen this incredible U.S. outperformance? Well, as we said earlier, that primarily it's coming from a change in valuation and not from a change in earnings growth. It's come from people rating U.S. equities higher relative to the rest of the world, and dramatically so over the last long period of time. But why are people doing that? Well, people might be doing that because they just think that the U.S. is going to have much higher earnings growth in the future, and so it deserves a much lower multiple. As Ravi was saying, that maybe the U.S. just has very different companies in terms of sectors and characteristics in the rest of the world. That's possible. But other possibilities are that the U.S. companies are buying back about 1.5 trillion or more of their own stock per year, and the rest of the world is basically doing zero of that, as far as we know. So in the U.S., companies are just going out there and spending 1.5. In the last couple of years, it's been $1.5 trillion, right? Like that is, 3 or 4% of the total market is just being bought back by the companies themselves, buying back their own stock with cash. And then, of course, another aspect of it is this sort of relatively self-fulfilling loop that you get into, where it's like, okay, let's have 90% exposure to U.S. equities. Well, if U.S. investors have 90% exposure want to have 90% of their portfolios in U.S. equities, but if the rest of the world wants to have like 30% of their money in U.S. equities, there aren't going to be enough U.S. equities to go around potentially. And it's just going to keep putting this upward pressure on equity valuations too. So, I think that there are some factors, and, we don't really see these factors dissipating right away. But at least it gives us some comfort that there's some understanding of what's been going on, even if it's going to persist. I mean, at some point, the differential in earnings yield just becomes large enough where it's really hard to overcome that with future changes in valuation too. I mean, 2%, the earnings yield of U.S. equities versus TIPS at 2% is pretty tight. It was actually zero or slightly negative about 23 years ago in 2000, and that didn't end well. So, from in around the year 2000, TIPS were yielding close to 4%, and U.S. equities and the rest of the world equities, for that matter, too, had an earnings yield of around 4%. So viewed in this way, the expected risk premium from owning equities was zero or slightly negative. And, that turned out to be a really bad time to own equities and a really good time to own TIPS. So, we're not as extreme as all of that now, but we do think that, that there are some bounds on these types of moves. So we've got a couple more questions coming in.
Okay, VJ asks, VJ asks, in the all equity portfolio, is there a floor for the US allocation? And if so, what is it? There's not a formal floor. In the new global balance strategy, with the flexible baseline, if you set the equity dial to 100%, then over the last 15 years at least, the lowest U.S. allocation you got, was in 2007, 2008, when there was about 15% U.S. and 20% non-U.S. In the current global balance strategy, let me just look really quick. I'm sorry, in the current all equity strategy, which literally stays at 100% equities all the time, the lowest U.S. allocation was about 30%. So no formal floor, but it's really, really hard for it to ever go below about 30% from a baseline of about 55-45. Victor, I think we've exhausted this group. So
yeah, it's great. It's terrific.
Yep. So we're at just over an hour. I think we should cut it here. And but if anybody thinks of questions, sorry, let me mute. If anybody thinks of questions, in the coming day or two, feel free to just email us, and we'll include a response with our post-call write-up, which we'll probably send out later this week or early next week.
Yeah, I mean, thank you everybody for being on this. I mean, we love this. I mean, this is a big source of compensation for us, is having these calls and seeing your faces, the names. It's wonderful. Thank you.
Yep. Thank you, everyone. And we'll almost certainly be doing an interim call, for the book. So
That would be the Yes.
So you won't have to wait 6 months for the next one.
And I look forward to receiving the book.
Thank you, Ravi. Yeah, we look forward to sending them. We're still kind of
It's such
working
a-
out the logistics.
It's such
For-
a teaser. I wish I knew the executive summary. What happened to the billionaires? So, or the missing billionaires. It's quite a teaser. Look forward to it.
Great. All right. Bye, everyone.
Thank you.
Bye-bye, everyone. Thank you.
Thanks for doing this.